Now, let's talk about the Forex market, basically the currencies market, okay? Just so you understand, currencies react to both economic conditions and global risk sentiment. And during uncertain times, we often see movements towards stronger or safer currencies. But at the same time, currencies linked to commodities like, for example, Canadian dollar, they link to oil, they also react. So what we've seen over the last 2 weeks is the shift in the market positioning, and investors are adjusting based on risk, and this creates movements across multiple currency pairs. And now again, the same principle applies when markets move in cycle, right? So what is strong today may weaken tomorrow, and what is weak today may strengthen tomorrow. And so the goal is not to chase the move right now. The goal is to understand what is the cycle. Okay, and that's exactly what we're going to do now. We're going to observe the top global, let's say, currency pairs in order for you to understand where they sit since the conflict started and where they may go should the conflict stop. Okay, so let's move to my screen, and we're going to take and we're going to look here. So we're going to start with the Euro US dollar. Okay, you can see here Euro US dollar. I'm putting the graph specifically on one daily graph. So every candle now here represents 1 day movement. That will be easier for us to reflect on the movement in total. So I'm gonna bring the mouse on the beginning. Here we go. You see, at the beginning of the conflict, the price, the exchange rate between euro and US dollar, because that's the euro US dollar currency pair. So the exchange rate was at 1.18. You can see that here, 1.18. That was the exchange rate just the day before the conflict started. And since then, you may see that the euro fell down day by day. This is 2nd of March, 3rd of March, and basically going down, 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 up until it dropped down to 1.14. So imagine the difference between 1.18 and 14, that's 400 pips. That's the huge distance that the market gone down for the last, like, what, 1.5 week. Okay, since it gone down to 114, it came back to 115. So it's recovered by almost 150 pips back. Now, what is that 400 pips? Just so you understand, when you do your trading, that pip value could be different. It could be $1, it could be $10, it could be $100, depending, of course, on your trade size. So imagine if your pip value is just $10 and the market gone down by 400 pips, we're talking about $4,000, right? That you could actually have made if you would be just trading one lot trade size. Now, with the leverage 1 to 200, that would just require from you about, like, what, $500. So that's how much you could make, right, by trading that small amount with that huge, let's say, movement down. Now, in order for you just to understand, now the market is very, very low compared to what it was. So should the conflict ease, right, the US dollar may continue to start going down, right, like it was doing before the conflict started. And remember, by the time any uncertainty or any type of this conflict starts in the market, what happens? Investors shifting into low risky assets, and that's gold. And that's also US dollar in this scenario. So they're buying dollar because in order for them to buy something else, let's say to buy gold or to buy anything else, because majority of assets in the world are quoted in dollars. So they're buying a lot of dollars. And in this type of events, dollar is getting stronger. That's why euro gone down. Now, if we look at the euro British pound, okay, we look at the two currency pairs in Europe, okay, and we're gonna look at the beginning of the conflict. You see here, so the exchange rate was 0.8787, right, and then it dropped down. Okay, euro dropped down against the British pound to 86.50. So it dropped down, give or take, about 150 points down, right? Since then, you see the British pound basically it's weakening a bit and the euro getting stronger, right? For the last, let's say on Friday, you see how much it gone up quite a lot, right? So this is euro GBP. Now, if you look at the USD Japanese yen, that is a very common currency pair that is used for trading, right? And we're gonna look at the beginning of the conflict. Okay, here we go. So look here. So the exchange rates between the US dollar and Japanese yen was at 155 by the beginning of the conflict, and since then the US dollar gone up a lot versus Japanese yen. As you can see, it hit 160 which is historically one of the highest levels. You can see even here, right? Every time it comes to that level, it rebounds back. So it's like a very strong resistance level, okay, to be seen here. And this is why it rebounds back. So look, 160 compare, like I said, to 156. So it gone up by 400 points, right? 400 points. Then it dropped down from 160. It dropped down to 157. So it dropped down by about 300 points, 250, give or take. And it going back for the last, for the last day. So look, in order for you just to understand, you see, it's a lot of movements happen in different currency pairs. So if we check it the same way, let's say with the British pounds, you can see that on the beginning, here we go. The British pound keeps dropping, as well as euro against the dollar, right, since the conflict started, because the US dollar getting stronger. So all this type of drops, as you may see here, right, create that opportunities to either buy the dip or sell from the high. Okay, so let's say we're gonna go and look at the USD JPY, okay, and let's look at the price where that was before the conflict. As I said before, it was at 155.85, right? Let me say that the conflict stops now and the price goes back to that level, okay, and therefore we're gonna go to sell it, and let's say we're gonna go to sell it with 100,000. Okay, trade size is basically one lot, so one lot trade size, right? I have a leverage 1 to 100, and therefore I need just $1,000 in order for me to trade that. And let's say I'm gonna go to the price as it was, 155. Okay, so that was the price that I wanted to go. In order for you just to understand the potential, okay, if you trade just one lot trade size with the leverage 1 to 100, let me just point it here. This is how much you need in order for you to trade 100,000. Okay, so you're basically selling 100,000 US dollars. And because of your leverage, which is 1 to 100, your leverage could be bigger, by the way. It could be 1 to 200, 1 to 300, even 1 to 1,000, right? And of course, your required margin would be lower than that. But with my leverage, okay, I need $1,000 to trade 100,000. And my potential return, so if you look at my potential return, it's $2,635 dollars to make. So it represents, give or take, about 200% potential return should the basically the price of US dollar versus Japanese yen just goes back to 155. Okay, and that might be the case if the risk basically starts to go lower. Okay, so this the same way we can do with the rest of them, let's say, and you can do the same on your trading platform, for example, just to see where the price was, okay, and just to see where the price may go, okay. And if we take, for example, all right, that was US dollar Japanese yen. Let's look at the euro US dollar, for example, okay. With the euro USD, as you can see, the highest level was at 120. Okay, and since then it dropped down to 114, 600 pips. Now it's recovered a bit. So let's say that there's an opportunity to buy it, okay, once the conflict starts to going down, and we're gonna go and let's say buy 100,000 as well. So with the leverage of 1 to 100, as I was showing before, to trade 100,000 trade size, I need $1,157 because that's going to be 100,000 euros. Okay, and then with my leverage, which is 1 to 100, you see that's how much I need. And let's say I want to make some profits, so I want the price to go back to 1.20. Okay, so that's where I want the price to go. So should the price go up to where it was, and this is the level, okay, just so you see, that's the level, 120. Right, should the price go up to here, right, from the level it is now, look at my potential return. My potential return is going to be $4,280 to make. So we're talking about 335% return, right, possibly that you can make once the price going to go back to 120. Where it was just before the conflict. Okay, so the only reason why the price of euro dropped down because of the huge basically selling euro and buying dollar at that time. But again, you never know when the conflict will ease, and at some point it will. It's nothing that lasts forever. No conflict, no crisis, no trend that lasts forever, same direction. So at some point it will turn. And that is what you basically need to be observing in the markets. And this is exactly why you need to be looking into the, let's say, news and following what's going on in order for you not to miss the entry point. An entry point when everything starts to shift back again, right? Whatever gone up a lot will eventually start going down. And whatever gone down a lot, like for example, you see here with the euro, right? Eventually it's gonna go back up again. So everything is temporarily, as well as the trends in the market. And if you look, for example, at the graph itself, okay, if you do it like that, you can see that the markets are actually cyclical, right? Whatever goes up, going down, right? Keeps going up and down, up and down. So markets never go one direction because people never just buy, right? They also sell. And obviously people never just sell, they also buy. So when the price reaches a certain level where there's no more buyers or there's no more sellers, that's where the price is actually turning back, okay? And that's what you need to be aware of, and you need to know when that happens. So this is why I want you to subscribe to my channel down here so that you can follow me on my next sessions where I'm going to be explaining to you what's going on and obviously where to take advantage of your trading. Okay, so this is something that I want to just quickly discuss with you about Forex market. I think this is also clear for you, right? So let's move forward.